A common thing that you hear, the market is very bad now, don't invest. Or, the market now very good already, go too high already, it's gonna crash, so cannot buy now. Let me wait for a better time. Then, I start investing. Do you catch yourself thinking like this? If you are, keep watching. While investing and trading do comes with strategies, for example, understanding your fundamental analysis, understanding technical analysis, right? Your Bollinger Bands, parabolics, your moving averages, your crossovers, all that. Or some might even dive deeper on options leveraging, and there are strategies to that also. For example, your cash secure put, your calendar spreads, your diagonal spreads, and all that. But with all that being said, is timing the market better than time in the market? Let's find out. Probabilities are what most professionals do and what they use to, of course, maximize their entry in the given market situation. There are strategies for a bull market. There are also strategies for a bear market. But should we do the same? Through this article on CNBC, the stock market hits a rough patch and skittish investors bail and park their money on the sidelines, thinking it's a safer way to ride out the storm. However, the math suggests quite convincingly that this is usually the wrong strategy. Getting in and out of the market is a loser game, said Lee Baker, certified financial planner and a founder of Apex Financial Services in Atlanta. Why? Keep watching and I'll cover more in this video. Is it really proven that by timing the market we will get better returns? Fun fact, that is actually true. So from Tuckman Research, it has showed from the year 2000 to 2019, and you put 10 grand, you stay fully invested, you have become 32,421, and if you have missed 10 of the worst days, your return may have doubled to 68,112, and if you have missed 20, again it doubled to 112,935, and so on and so forth. If you have missed 60 worst days throughout the good 19-20 years, that same 10 grand have become 504,000 in 2091. Boom! That's quite insane. Your returns have increased from a mere 6.06% per annum is 21.66%, 300 plus times. And besides this, by Vanguard, as you can see, from 1988 to 2022, if you stay fully invested, it's 10.4. However, if you have missed 50 of the worst trading days, your return per annum have reached 19.9%. Crazy stuff. From 2003 January to December 30th, 2022. If you invest 10k, if you stay invested all the way, you would have 64,844. However, if you have missed just 10 of the best days in the stock market for the past 20 years, that returns now have dropped to 29,708. And if you have missed 20 days, you have gone to 17, as you can see, so on and so forth for 30, 40, 50, and 60. Another record from visualcapitalist.com, these are the exact returns that is going lower and lower from 2003 to 2022. If you miss 10 best days, your net return is only 5.6 compared to investing all the way of getting 9% per annum. And of course, if you miss 20, 30, 40 best days, the returns have dropped significantly along the way. This shows a longer time frame, 30 years, 1993 to 2022. And this shows also the relevant returns if you stay invested versus missing the 10, 20, and 30 best days from the chart here. So these are stats that have been put out to show that if you just miss the best days, your returns may be significantly reduced. So with all this research, the question is always this: is it possible to actually time the best days or even enter at the best days? Let's find out. On Tuckman Research, he has showed that the days of the worst and the best happen in cluster. March 2020, the second worst days in 20 years happened on the Thursday, which is 12th of March 2020. It pulled back a single 9.49% in one day. And the next day, on Friday, on 13th March 2020, it was the fourth best days in 20 years, where it rose 9.32% that single day. Shortly after, the following Monday, it was the worst day in 20 years, where they pulled back 11.98% in a single day in March 2020. That was on the 16th. Another example, on 24th August 2015, it was the worst day of the year, followed by 2 days after, 26 August 2015, it is the best day of the year. And the last research, 24th December 2018, it was the 6th worst day of the year. However, 2 days after, at 26th December 2018, it happened to be the best day of the year. Over the last 20 years, 7 of the best days happened when the market was in the bear market territory. On CNBC, the S&P 500 best days tend to cluster in recessions and bear market. Take note, it clusters in recessions and bear market. A good 56% of all the best days in the S&P 500 actually happened during the bear market, and 26% happened in the first 2 months of a bull market, which is just the really start, and 22% remaining, it actually happened during in the bull market. That means a good 82% of the best days happened when your emotional states were rather negative, rather doubtful. If you can see CNBC as a fear and greed index that measures market sentiment, it shows that you may be in a very fearful state, in a doubtful state, or you might need more assurance. All these words that will be packed on that current state of mind, you may not have took on the opportunity to leverage on the best days. Interestingly, the worst days in the market typically occurs in the bull market, and this according to Wells Fargo's. Some of the worst days actually occurs in the bull market when things are hopeful, periods when the stock market is on a winning streak. Through visualcapitalist.com, it mentioned that the worst days in the market typically occurred in the bull market. As I repeat, the worst days in the market typically occurs in the bull market, which explains, again, psychology, emotionally, you may be in a greedy state, you may be in a really hopeful state, you may be in a really positive state that the market will grow and all that. So would you really pull out with that psychology and emotions in mind? It might be really, really hard and close to impossible. Of course, if you're a legend, I think I can give it to you, but else, it's really hard to time the market on both aiming the best days as well as avoiding the worst days. As I quote from Vanguard, the problem is that there's no predictive power of whether there is going to be an up day or a down day. So going back to the first chart, if you think it might sound easy to miss just the 10 worst trading days, the reality is that it's not, because those good days tend to occur in close succession. Given this reality, if someone leaves the market after experiencing a poor return, it is literally impossible for them to get invested in time to benefit from the best day that may follow. Here are 2 key differences with this scenario. To miss the worst days, there is no signal to get out of the market, equal there's no emotional trigger and moving investors to sell. Second is the investors would need to buy in on the worst days during some of the most significant market drawdowns when loss aversion is at its greatest. I think I shared in my previous video also, the Wall Street cheat sheet. Given the emotion, is it mentally possible to invest in when it's the worst time as perceived it to be? Even through this video of Warren Buffett and Charlie Munger, let's see what they have to say.
We haven't the faintest idea what the stock market is going to do when it opens on Monday. Charlie and I don't think, in all the time we've worked together, and I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do, or for that matter, what the economy is going to do. We don't know.
Yep, you get the gist of it. And another video, he mentioned the same thing.
Unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company.
So through these 2 videos, it seemed like Warren Buffett and Charlie Munger, they seldom go in the market because of timing. They focus a lot on how great the company is fundamentally. If you're wondering what I shared earlier, is it old news? Does it still apply now? Let's see this research on Wells Fargo Investment Institute, and this is dated February 29, 2024. The period of trying to time volatile markets. And you can see that number 1, the chart 1 shows the market timing is difficult because investors who allow their emotion to get the best of them may suffer lower returns. And you have showed that missing the 10 best days. This is updated February 1, 1994 through January 31, 2024. If you stay invested throughout, annualized is 8% per annum, and you missed 10 days, you have dropped to 5.26. You have missed 20 days of the best days, you have dropped to 3.41, so on and so forth. And the latest update is if you have missed 50 best days, you have received a minus 8.6% return. And also, according to the latest article by Wells Fargo's, 3 of the 30 best days and 5 of the 30 worst days occurred during the 8 trading days between March 9 and March 18, 2020. Thus, capturing the best days and avoiding the worst days may be tougher than it really seems. Timing the market has been proven to not work so far in the past references that I've shown, or it might not seem it's going to work out anytime in the future. So I strongly believe time in the market is much more effective and profitable compared to timing the market. Staying fully invested in equity market over a full market cycle, it's more beneficial than selling into the volatile markets, attempting to avoid the worst performing days. I hope this video gives you much assurance and confidence that even if you're going through a tough time in your investments, the good times may be coming soon. I hope this video is helpful for you guys. If it's helpful, let me know in the comments below, and I'll see you in the next video. Peace!